Hey, thanks for checking out this second installment, midweek edition, really, of the FinPrep market update coming in here into the Fed week. So, Fed Board of Governors meets as well as we get the minutes released. I believe it's Thursday at 11 a.m. Pacific. You can confirm that for yourself online, but tends to be an interesting time for market prices to react in response to what the Fed says and does, as well as plots. So, we'll take a look at that and keep it a keen eye. But generally speaking, heading into these meetings, it's an important time of inflection for prices. So we wait and we see what happens. So pause the screen, read the disclaimer closely. The information contained herein does not constitute investment advice and should not be used as a basis for investment decisions. To obtain investment advice, contact a registered investment advisor. FinPrep and its affiliated parties should not be held liable for any investment decisions you choose to make. The material contained herein is for informational and educational purposes only. Alright, so a little bit different of a segment, and basically it's how 30 seconds with Microsoft Paint, you can pull these charts on any sort of website, Yahoo Finance and so forth, but how 30 seconds with MS Paint could basically keep you appraised of the risk of a 50 to 60% drawdown in the overall equity market. So what do we have here is a monthly bar chart extending back. The relevant early range would be 1995 here, and here's your tech bubble. And the key here is that you get your correction into the Asian crisis, 1998, as I recall. And once price kind of slips, you get your touch points here, 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 here. Once price slips through, it then begins the process of drifting downwards into a bear market. Bear market finds its bottom in 2003, March, yep. Beginning a rally, you get your touch into 06, and then slipping through in 2008. Kind of getting this rally back into the underside of the 20-month moving average. That then, though, fails as price moves below this trend line established by those new lows, which could have been argued just to been kind of like, are we fanning? In other words, ascending at a descending rate of ascent, slower angle, basically lower angle, right? So not as steep, kind of as what happened here in the prior bull market or bubble, whatever you choose to call it. In the case, though, the price drifted up against that, actually poked above on an intra-month basis, but still failed to close. And then we had our financial crisis lows, right? So out of every bull market, you could bear a bull, and conversely, at the peak of a bull, potentially, that's when you give birth to a bear, right? So it's just the nature of life, right? Cycles. So basically, you're finding your low into your financial crisis, extending in through the 2011 low. I believe that was the U.S. debt downgrade and other issues, and we just slipped through that this summer, basically. And the correction really kind of got everybody's attention, as we discussed in the prior episode. But basically, if I was to give benefit of the doubt of saying, well, gosh, perhaps, yes, the primary trend has been put to pass, but what if we just ascend at a slower rate of ascent? We're just going to go higher, slower, right? In other words, well, the question there then would be, to see, or the point at which that point of view could then become seriously questioned would be about this 183-ish on the monthly bar chart of this new trend line, which now extends to this revisited 180 level on the SPY. So keeping an eye on that. Doesn't seem to be the most pressing of trend lines to be challenged. We'll look at the more shorter term ones up and around 204, but that is something we want to bear in mind. So should price slip through here, you want to actually plan and make decisions and consider adjustments with your registered investment advisor in this territory rather than down here and down here at the trough. And the reason that's mentioned is a lot of the data that's displayed with retail fund flows shows kind of what they call mom and pop, getting involved up here and getting out here, getting involved here, getting out here. That's not a great way to compound your wealth, is it? So not wanting to get out down here, but rather to think about when is it appropriate, at what stage off the peak are adjustments made. So just food for thought. Looking at the near-term action on the daily chart, right? So we basically had a massive gap up out of that holiday weekend on Tuesday. Coming right into that declining 20, as we discussed on the last video, was a strong point of resistance. Price sold off that entire, I believe it was Wednesday there. But though drifting up again to retest the 20, which would be a sign of strength since it wasn't soundly rejected and retesting lows, but kind of still showing that stubbornness or that strength, and now coming back into this, actually connecting the tops, basically, you get a trend channel. More importantly, though, would just be this round number resistance at S&P, or a SPY 200, more or less. So seeing if we could, how price responds to that level, given Fed meeting and Fed minutes this week. Should that be taken out, it opens up the door for 204, which would be the underside of your previous source of price support in 2015. And then what becomes of that? Should things materialize to the downside with respect to price, 184.50-ish would be your kind of immediate source of potential support, opening the way to 187.50. Okay, so that's the SPY. On the positive or bullish case, price did recapture this downward channel, right? So it's within this range, but still holding on a verdict until we see the reaction of what transpires this week post-Fed. Dow remains the laggard, price not having recaptured, and death cross in effect. And just to pop back to SPY, an ever so slight death cross was triggered today, despite the upward action. On NASDAQ, on the Qs, you have what appears to be an ascending triangle, potentially with bearish resolution should price break out to the downside. Up against resistance here, so needless to say, pretty key week here as we head into Wednesday, Thursday, and particularly we close on Friday. But basically, can price reapproach the 109-ish area, or do we fail out of the ascending triangle on what is otherwise a pretty strong sector currently? Same thing with trannies, transport. So basically, price having taken out this downward channel, though somewhat potentially reminiscent of what we saw here earlier, you kind of got this breakout, thinking it's positive, but chopping around, only to enter the correction. So the question is here is, do we drift lower during the week, or does the market respond favorably to whatever the cause? Potentially Fed minutes, rate hike, no rate hike, ZERP, no ZERP, whatnot. Massive volume today would seem to be a bullish indicator. However, when we drill into the 1 minute chart, it'll be noted that the primary source of the volume would appear to have been at times when selling pressure was the norm. So it's actually curious. We don't have transparency though into the microsecond level where much of the data also does occur, but this is 1 minute. It's about as fine as we can get for free. That is freestockcharts.com. It's a good source, and we're thankful for it. So Russell, small caps, again, a seemingly positive sign as prices re-entered this downward price channel, as opposed to the trannies, right? Didn't break out, but still within it, which is what you'd want to see a bullish scenario. We discussed biotechs looking forward to a resolution off the 250, right? And indeed it did, gapped up above this downward trend line, and it's kind of floated up and actually met resistance if you're connecting the tops in terms of price resistance and kind of just chopping away. But basically, you're going to have a lot of potential source of resistance at 360. So what price does here in the next few points, it's going to be incredibly interesting and arguably pivotal for the entire market. TLT treasuries, long-term treasuries, did briefly open outside of the range we discussed between the 50 and the 200-day moving average on Wednesday, but did drift up in the entire session to close up on the week. We did lose that kind of range, as it were, but we are drifting into price support on this somewhat of an inverted wedge in other contexts, but basically this kind of expanding field of volatility. So looking for this as potential support for a move upward should treasuries react favorably to Fed. Dollar index, nothing much to see here, pretty tight movement, but losing the 200 and then being capped at the 20, declining 20-day moving average. Not to say that necessarily suggests further downside. It's possible, but it's kind of all hands on deck, everybody on hold until minutes are released. Oil still within the potential bull flag, finding support at this rising 20 DMA, which is seemingly kind of an encouraging sign for resolution to occur, assuming the proxy that flag flies at half mast, courtesy of I believe Edwards and McGee, would suggest the possibility to still potentially reapproach 200, although that's a heck of a journey. Certain Wall Street firm calling for oil to approach $20 a barrel. So it remains to be seen if pattern will fail. It is a possibility, though. The other commodity we spoke of on the last one was copper, and yes, we did get a gap up immediately on that. Right. So sorry, Tuesday. We were looking at Friday close. So less one was involved basically on the Friday close. Much of the move, which has transpired since then, basically occurred on the open on Monday, and then meeting resistance here down to, on the declining 50. So, but still within that price channel, the long-term, I believe 4-year price channel. So the throwback has not panned out currently to be a throwback, but really sort of kind of just like a fake out, as it were, a whipsaw, as it's known, to the chagrin of many swing traders. So that is the market wrap so far, what we've missed here for the past approximately week and a half, but looking forward to how market will react and respond to outcome of Fed meeting and Fed minutes. So bracing ourselves, anybody with levered positions heading into this Fed minute that didn't bail throughout this chop, best of luck. We'll see what happens, and again, looking for kind of better resolution. Many indicators seeming to point in the near term to a potential retest of 200 and 204 on the SPY, but if market reacts adversely, looking for potential resistance at support at 194 and 187 ish. So we will see what happens. Keep you updated next at the end of the week here. Thanks.